Ladies and gentlemen, last week we warned Jerome Powell that if he doesn't cut rates, we riot. He didn't listen. So today, we're unleashing the Rate Riot Rally. New York, bring your memes and your megaphones. Stand by for the revolution. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were mixed on Wednesday with the prospect of the US joining the Israel-Iran hostilities, keeping investors on edge as the Federal Reserve held interest rates steady while officials diverged over the ultimate path of interest rate cuts this year. And as a result, we had a very, very mixed day. There were winners, there were losers. Such goes the market. Some of the mega caps did perform very, very well. Nvidia and Apple specifically, along with AVGO, very, very green. And that meant hardware as a whole was actually pretty green. Microsoft was up 0.46%. Meta was down 0.21%. And Google was down 1.49%. Software as a whole really took it on the chin today, except for Palantir and Oracle, both up about 1.3%. Financials, very, very bullish again, led by JP Morgan and Berkshire Hathaway, but held back by some of the price action we saw in Visa and MasterCard. We'll talk about why a little bit later on. We saw Tesla gain as well. Amazon fell as well. As you can see, guys, it was a very mixed day across the board. We had about half the sectors gain. The best performing sectors being the XLU, XLRE, that's the real estate sector, as well as the XLK, XLC, XLY, that's the tech sector, communications, and discretionary, with the S&P 500 virtually flat here today, weighed down by stuff like energy, gold, materials, industrials, healthcare, and staples. But all in all, it was actually a very, very positive day to open the day. You could see we were very, very positive, and then as the day went on, we paired a lot of those gains, and you could see we had quite a lot of volatility here, especially once we had the FOMC, which we'll talk about. This is when Jerome Powell announced his rate decision and started the FOMC press conference. So a lot of optimism coming into the day, and then that all sort of died down. However, look, broadly still a green day when you look at everything in aggregate. If you just remove large cap growth, large cap core, which are the biggest sectors, but let's assume equal weighted, right? We actually saw a very positive day. And in fact, a positive day led by mid caps, led by small caps, right? Especially small cap growth up 0.68%. And really it was a day for small size and value, as you can see. And then, those larger cap names are not faring too well. And that's because there is still some geopolitical concern under the hood. And this will continue for the foreseeable future. Trump came out and privately approved attack plans for Iran, but has withheld the final order. And I think that's because a lot of his initial base are probably revolting against him, saying, hey, we voted for no new wars. You are literally engaging in a war helping Israel, looking for regime change. And that's probably why we haven't had this final order. But I truly believe that we probably will see, maybe not boots on the ground, but definitely some form of air support from the US in this Israel-Iran attack. That was one reason why stocks were mixed today. And that was the reason why stocks have been mixed for the better part of the last week. But I think the big reason was also some of the economic data that we got today. If you look at building permits, right, it came in slightly below expectations along with housing starts. And if you look at the month over month, we get negative 9.8% here for housing starts. We also got Lennar's earnings just a couple of days ago. Very, very ugly earnings. I mean, earnings per share, net income, they're like 45% on a year-over-year basis due to incentives and just revenue decelerating in that entire sector. So the housing sector in a lot of peril. Initial jobless claims came in at 245,000. That was at the consensus. So look, the labor market's still looking pretty good, coming at around the consensus, but we definitely are seeing some signs of the labor market unwinding and just loosening relative to the robust labor market we've seen in the last couple of days. And then we also had the FOMC as well as the economic projections, and the Fed held the interest rate steady, left the Fed funds unchanged at 4.25 to 4.5% for this meeting. Now, the economic projections kind of benign. The Fed is looking for slightly lower growth, 1.4 versus 1.7%. That is for 2025. They're expecting a slightly higher unemployment rate, inflation to tick up, both in the headline and core figures, as you can see right here. So long story short, what we're seeing is slower growth, higher inflation. And that is why the Fed simply didn't cut this time round. Why would the Fed cut when they're looking at this data and seeing slower growth, higher inflation? Rate cuts might actually stoke the inflation component of that and not necessarily definitely help the growth component, especially when you have stuff like tariffs and this new spending bill coming to front of mind. Here's the dot plot and what each Fed member thinks interest rates will end at this year. It was very divided. 7 Fed members expect 0 rate cuts in 2025. 2 expect 1. 8 expect 2 rate cuts in 2025, and only 2 expect 3. So there's actually a huge divide between if we should cut and if we shouldn't cut. And again, that is why we saw volatility in the market. And then here's how the dot plot changed from March to today. 2 Fed officials that said in March they expect 1 rate cut in 2025 today said they now expect 0 rate cuts in 2025. And on the back of this, the S&P 500, like I said, was very, very volatile. We kicked the day off very bullish, paired some of those gains, and then when we had the FOMC, the press conference, right, things got very, very volatile, but the aggregate trend was to the downside, particularly from these highs. You can see we pulled back, paired all of those gains, actually finishing flat for the day, slightly negative on some books. It really depends which way you look at it, but in aggregate, a very volatile day, a lot of mixed price action. And that's just because there's a lot of uncertainty now on the fiscal side, the monetary side, the geopolitical side. Everywhere you look, a lot of uncertainty. And even though the market does climb on uncertainty, initially in the year now, it's causing a lot of volatility in the market. Looking at some market movements, AMD was down 0.31%, but again, very, very volatile. That was sort of the trend. Stock did rise 1% in the pre-market, following news that it plans to partner with Microsoft to develop custom chips to power the next range of Xbox systems. Now, Circle Internet Group, guys, this is absolutely crazy, was up 33% today as the Senate passed a bill to regulate the sector, that being the stablecoin sector. Circle Internet Group is now up 500%. I said to you guys, if you have the opportunity to get into this IPO at $31 a share, go ahead and do that because it is going to be very, very good. The market's going to love this. Unfortunately, I'm in Australia. I didn't have access to this IPO on any of my brokerages, including Interactive Brokers for some reason. And here we are. For those of you that are invested in it, congratulations to all. And then on the back of this legislation, MasterCard and Visa were down 5%. Look, big retailers like Walmart and Amazon are now exploring ways to launch their own stable coin, right? Coinbase is rolling out its own Coinbase payment system. We have JP Morgan launching its own stable coin. We have Circle Internet Group going public. I think stable coins and as a way to reduce bank fees are definitely going to come to front of mind, and that's definitely a trend that's going to take place. And the valuation premium that MasterCard and Visa command, that might go away. The business model, while I don't think it's going to be an existential threat, I think you're definitely going to see the market re-rate it accordingly. That being said, this is what it's going to look like, and that is the price going lower. And I wouldn't be surprised to see if this continues for probably the foreseeable future, at least the next couple of years, until we actually get certainty as to what stablecoins will look like, or if Visa and MasterCard can actually maintain their moat. And then for everything we saw today, there was 3,500 advances, 2,700 decliners. We saw net inflows in the New York Stock Exchange, huge outflows in the NASDAQ 100. The S&P 500 was kind of flat today, and market momentum continues to not look that great. The 50-day above the 50% mark, and we could see we are approaching that levels here in the 20-day as well as the 100-day, very, very close to the 50% mark, but not quite there. And then the 5-day, very volatile. So we'll just exclude it for today. But yeah, look, everything looking kind of mixed. This is something I would expect based on the price action we have today. The shorter term averages with the 50-day kind of look okay, but these longer term averages, we still aren't able to retake that 50% mark. And only once that happens, like it did right here, then we could see proper momentum to the upside. Diving into the charts, you could see that the S&P 500 and NASDAQ 100 were kind of flat for the day. However, the IWM outperformed, same with mid caps and small caps. So truly, we are seeing higher beta, smaller size outperform, and that has been the case for the better part of the last week. European stocks fell today along with China stocks as well. Volatility very, very mixed. You can see that spot VIX actually fell on the back of everything we saw today. And that's mostly because, the Fed press conference there's a lot of implied volatility that comes from that. That is now behind us. But forward front month contracts, actually, volatility did increase ever so slightly, telling us the market is seeing less near-term volatility and slightly more longer-term volatility. Again, on the back of this very mixed price action, and that is the theme for today. The 2-year yield fell, the 30-year yield was flat, and the 10-year yield actually rose ever so slightly. Bonds gained, but were virtually flat on the day. The dollar was flat as well. Gold up 0.14%, Bitcoin up 0.14%, silver flat, and then WTI up 0.24%. And you can see here is the S&P 500. If we just quickly zoom in to where we are right now, you can see very, very obvious price action. We said we are looking for a little bit of weakness into the end of this week, into the FOMC, potentially looking for lows as low as 58.53 right here. Now, I will say it does look like we are finding a little bit of support here at the 59.80 level. You can see that if you look at these wicks, this is telling you that bulls are stepping in and buying the dip at the bottom right here. And we also are seeing a lot of selling on the top end. Look at these wicks telling us that we are having a struggle, a power struggle between the bulls and bears. Either way, I think if we get good news from Israel, good news from Iran, good news on the tariff front, or a very solid trade deal, and we do know stuff like Japan and the EU trade deal, Germany as well, are currently underway. If we do get that, we can definitely move to the upside. However, if the market continues to do what it does today, we weren't able to get some juice from the FOMC, I think we are probably going to go lower. Remember, guys, that the second half of June tends to be seasonally weak. However, the first half of July tends to be very, very strong. So in the next week, week and a half, we are looking for an opportunity to buy the dip. Hopefully, we can get to this 58.53 area. I would really love it if we got here, find good support, and then rip to the upside. But as it is right now, the bulls and the bears are putting in the work to both sell and buy. We'll see who ends up at the top. It's a very similar situation for the NASDAQ 100, selling off the top end, bulls and bears coming in, stepping in. We're a stone's throw away from all-time highs. But if we do pull back to this 990 area, I, again, wouldn't be surprised. And I'd be a strong buyer right here, especially when we look at everything that's on our side right now. I do think we go higher. Corporate earnings per share, next 12-month earnings are actually moving higher. Estimates coming into this year were for about $278 in earnings per share. They're now looking at about $281 in earnings per share. So, and again, this even includes the tariff dip. So earnings per share continues to move higher, and I expect this to continue to move higher as the year goes on. And again, the biggest beneficiaries of that is going to be the S&P 500 and the NASDAQ 100. We can also see the RTY. Guys, if we do get to this 2000 level, this 2070 level right here, buy that dip, because I do think we are going higher. And I do think we are going to go ahead and take out these 52-week highs right here in the IWM sooner rather than later. And then let's actually have a look at European stocks. They are rolling over. This is something we said that would happen. Guys, the support zone is going to be this 527 area right here, but give it a couple of weeks. That is where you're going to find support in European stocks. Let's actually go ahead and look at Chinese stocks really, really quickly. We're going to look at the KWEB. I don't really like the price action I'm seeing right here. Very, very volatile, but it does look like we are in a range here in the KWEB, right? I would say that probably below this line where we are right now, you want to be a buyer. Very, very wide range, very, very volatile. You want to be a buyer in this area, looking for us to move higher in the KWEB names. And then looking at gold, guys, we did say that we are forming a triple top right here at this level. Now, obviously, because of the geopolitical uncertainty, that is going to allow gold to get a little bit of strength along with WTI. But this does look like a triple top. And until we actually go ahead and break above this level right here, I probably remain structurally bearish on gold, looking for consolidation in this period after what has been an immense run up in gold in the last 12 to 18 months. Very, very solid move. And then looking at Bitcoin, you could see that we followed the trend pretty religiously. Guys, I still am very, very bullish on Bitcoin to go to the upside. And again, this is because of the indicator we use tracking global M2 money supply here for Bitcoin. Guys, looking at the dollar, one thing I can say about the dollar is that we probably will see a little bit of strength from these levels right here. The BOFA Fund Manager Survey said that dollar bear or dollar shorts were at the highest level since 2005. Honestly, that's normally a signal where we do see some upside in the dollar. And I do think we probably will see some upside in the dollar, probably to the 101 to as high as the 104 area. Guys, I'm diving into sentiment. This is CNN's Fear and Greed Index, and we are officially in the neutral zone. And guys, when everyone's bearish, there is a lot of panic. When everyone's bullish, there's FOMO. But when sentiment is neutral, that means people are unsure, and that's opportunity. No one's crowded in. No one is all in. There's dry powder waiting to be deployed. And guess what? Markets love to climb when no one's paying attention. Remember, in markets, indecision isn't weakness. It's calm before the rally. And talking about dry powder, when we look at household checkable deposits, it is up in a very, very big way, especially from the COVID lows. Absolutely insane. So the consumer is actually flush with cash. And when we look at earnings, right? All of that cash eventually materializes into earnings, and earnings estimates, while they have seen quite the revisions over the last couple of months, particularly from January, as you can see right here, they are starting to bottom out. In fact, over the last couple of weeks, we've actually seen a little bit of upward revisions in the S&P 500. And when things go sideways, that's often an indicator of a trough. From here, we can go onward and upward. And I have no doubt that we probably will see the $280 region sooner rather than later. And that's because the macro looking really, really well. Q2 GDP estimate at about 3.5%, down from the 3.8% mark that we saw earlier, but still very robust for this quarter. And guys, the biggest mover of the economy and the macro over the next couple of years is Trump's big, beautiful bill. Here's all the inclusions from the House and then the key revisions in the Senate. And this is how FMS investors are feeling about the big, beautiful bill. You can see, is it going to have little to no impact on economic growth? 59% of individuals say no, but 81% say it's going to increase the deficit significantly. So little impact on growth and a big impact on the deficit. Nonetheless, I think this bill, especially with a lot of the tax provisions it has in the Trump accounts, the overtime pay, the SALT deductions, I think that should be really, really positive for the market as a whole, and it's going to benefit Wall Street more than anybody else. Guys, looking at earnings and data, there's actually no data tomorrow that's of any consequence. And then when we look at earnings tomorrow, Friday, we just have Accenture and Kroger. That's pretty much it. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.